Hi, this is Randy Finney with the Right Side of the Chart, and today is Wednesday, March 17th, 2021. I want to do a quick update on the equity markets and maybe a few of the other things I've been watching lately. But most notably today, we have the breakdowns below those minor trend lines, sell signals triggered on QQQ and NQ. Again, near-term sell signals. So to recap, we did have a rejection yesterday, or at least we stopped cold at that top of that trading range back from here, and then went on today to gap down and continue lower. We're down about 1.3% right now on QQQ, and so that is a near-term sell signal. So still leaning towards the possibility or likelihood, I should say, that this was a counter trend rally in a correction with more downside to come, but it's of course at this point much too early to say. Again, this is a near-term sell signal, could be the beginning of the next leg down, or it may just be a one-day pullback. So we're still going to watch that the recent highs from that trading range right there, about 324.65, give or take, and then what will increase the odds that we're going to go and hit this next target down here, a potential target of 283 on QQQ, would be a break below the levels that I'd watch now. I think are important are 310, around 310 right there. Turn that one up because we have that was the bottom of that same trading range from right here. This trading range I'm referring to. So that trading range, we broke below it, hit the first target of 297, reverse from there, had the typical reaction so far, which is a bounce off the initial tag of a price target, and went back up and to the top of the range and stopped there. So, again, this could just be a pullback, but if we break below 310, I believe that'll open the door for move down to another run at that 297 support. And being that it was already hit once, if we get even close, my expectation would be that we'll go on down through it, or maybe with a very little, if any, reaction, I should say, because again, we've already had a reaction there. So first things first, and that's it. Let's see which way we go here. Break above a solid break above 324.65 bullish, and a solid break below 310 bearish, and that's what we'll be looking for. All right, NQ, NASDAQ 100 futures, showed you, I believe, yesterday this bearish rising wedge right here. There's your uptrend line off the recent lows. There's your divergence here, at least on the PPO we have divergence. Almost divergence on the RSI, slightly higher high, but for all intents and purposes, and again, that's almost flat line divergence with prices making a higher high. But either way, this is a bearish rising wedge pattern, and we broke down today, so that helps to confirm a near-term sell signal. So when you get this, what we'll be watching for, should they ramp it up, and that's all we get if the buyers step in here and foil this, what is a decent sell signal right now, as at this point in time. The bears, or those short, have a check mark with that breakdown. It should take us down back to at least this first support here, about 12,704. But should the buyers come in, ramp it up, and make another run. Now I will say this, I'm just going to show you the lines here. We've reversed just shy. I have a resistance level here. It's not super solid, but it's decent resistance, about 13,342 on NQ. And if we ramped up here and we did come up there and didn't do anything more than that, it would pretty much give us a back test, or it may give us a back test of this trend line, and then we could reverse. So let's just, again, it kind of meshes with what I was just showing you on QQQ yesterday. At QQQ, remember, we hit the top of that trading range. This is a comparable trading range there on NQ, the 60-minute chart. These are the futures. Excuse me. So again, anything much more than a kickback to this level is going to take out. It's going to break us above this recent trading range right here, and it would also then take us back most likely above this uptrend line and price resistance. So again, that would be, you could still keep the case for another leg down alive and move up to there. Now, should we just go down here and then we go on and take out 12,704, or we'll call it 12,700, that would be even more bearish. Okay, let's look at a few other things I'm watching. Small caps, RTY, the futures rolled. So in the charts I was giving you up until including the one yesterday, those were the previous, those were the March contracts. That's stop trading, or will stop trading today or whatever. So we've rolled to the June contracts. So therefore, the targets might be a little bit different because it's a different contract, but they're going to be similar. T1 still around. Yesterday, I think I had it at 22. I'm looking at the other chart, 22.5880. We'll call that 22. Close enough here to the 2264 right now when I roll to the June contracts. And what I mean is that's the lines at a comparable level, the same reactions along the way there. So that's still the first target. Since yesterday, last update, that chart I posted yesterday morning, we're right here on minor support. I said a break of that support would be the next objective short enter a sell signal. We broke it. Swift move down, hit this 2300-ish support, minor support, bounce there, and then took that out. You're coming up on minor support about 2279, but again, this still remains, we'll call it about 2260 first target. And then if we get some downside traction in the market and we take that level out, that would open up the door for potentially for a move down here to the second target zone, and that is RTY, the small cap futures. And here's what it looks like on the IWM daily chart. You have a long-term trend line. This is very significant. This is the trend line off the March lows in IWM. We're still comfortably above it, and that's still a swing target here for IWM on the daily time frame to come back and at least test that. And that could keep the longer-term bullish case intact. If it holds. Let's say we do pull back there and successfully backtest it and rally. However, if we break it, then that's going to be bearish, and that would open a door down here to this potential target I have here, about 170, big level that I think there's pretty good chance, especially if the large caps, break down, have another leg down, we'll probably see the small caps come in. That was a major breakout level right here. We had several highs there. Big reaction highs, finally broke out, and a lot of buying, an impulsive leg up, but we've yet to back test it. So again, that would be when we zoom back in tight, should this uptrend line go, that would be a logical target there for IWM. Small cap ETF. And you also have this potential megaphone or broadening wedge pattern. But what's more important than that is this divergent high right here, this negative divergence that continues to build, and that would be the potential technical catalyst for a reversal and a correction there in IWM small cap. I probably should talk on SPY real quick. SPY, as with QQQ, they've taken out that trend line off the March lows already. Again, the small caps only hasn't done that. So there was a breakdown, back test of the primary trend line, leg down, another leg up to really put in almost an equal high, a slightly higher high, a marginal new high, which is still a divergent high. That divergence has been building for a long time. And then zooming in tight, the trend line is not as well defined here as that uptrend line on NQ or QQQ, but there it is. A breakdown, a little back test, and we're moving lower somewhat, but again, the S&P 500 continues to show resiliency, which is an argument for the bulls that overall the majority of sectors are holding up, and the correction, that 12% correction in the Nasdaq 100 recently was primarily just a correction in the tech sector. Now, tech is the largest sector in the market, so it obviously put pressure on SPY, took the S&P 500 down as well. But as of now, we're seeing a lot of sectors hold up. But again, you can trade sectors. You don't have to trade. When you trade the broad market, especially the S&P 500, you're trading 11 sectors, 500 different stocks in many different industries. So if you're long the S&P 500, you're long the most bullish companies and the most bullish sectors. You're also long the most bearish. And so when you drill down to the sectors, there's the energy sector, which I mentioned is an objective short recently on this run XLE that run into the big resistance at 53.61, and there it is. You can see this one is obviously one of, if not the most bearish looking sectors right now in the S&P 500. Beautiful uptrend line, big divergence, and a nice breakdown right there. And this is day 3 of selling. Nothing but red sticks so far, red candles, since not just the breakdown of the trend line. What I liked about this one, it also rallied into major resistance, and it's stopped it cold. 1, 2, 3, 4, 5, 6 days trying to get over that 53.61-ish. And again, that goes back a long way. That's a significant resistance, and then a failure. So again, you could be short the energy sector and long one of the most bullish sectors or individual stocks if you want to trade a diversified portfolio or a hedge portfolio. And then the other ones that will move along with it are XOP, and that's the exploration and production sector. All right, there, primary uptrend line broken, back tested for a while with a minor channel set up below it right here, a minor uptrend line, and then again, just like XLE, breakdown candle on Monday, followed by additional downside so far. And then you also have XES, and that one again, solid breakdown yesterday, big red candle below a well-defined uptrend line, and the fact you had the negative divergence tells me there's likely more downside to come, at least down here to that 55.44 first target. And of course, the fate of the energy sector ETFs and individual stocks will always depend on what crude is doing. So let me find my CL chart. Here it is. Okay, CL, crude futures. This is a 60-minute chart. There's everything covered recently. Most recent, the small little divergent high right here. And yesterday, when I did the update, I believe we were at, or right on the 63.79 support. That's this big reaction high right here. And we had a breakout of it, consolidated under it, rallied, back tested with a slight overshoot, but enough reactions. And that, again, that was yesterday. We bounced, and as I said, and I still maintain, we need to break 63.79, and then just below it is this reaction low from a couple weeks ago, a week or so ago. If and when that goes, that should open the door to move down to my first target there, about 61, and quite likely eventually my second target there around target zone around 58.90 up to about 59.45 or so. If that plays out, and again, it's contingent on a breakdown in crude, you're talking a drop of about 8% to the second target zone, and that will most likely take those energy sector ETFs and individual stocks down with it. However, if crude's been very resilient lately, if it can hold this support or this support and rally and go on to make new highs, and then those energy sector ETFs may go ahead and break above that resistance. But there's quite a bit. You're going to have to take out this recent high in crude oil most likely to see XLE and those others go on to break above resistance. So as of now, I still favor this scenario, and that also meshes with a little more downside in the market. And then maybe some good news for those of you that drive a lot. I had an alert go off on UGA today. UGA is the unleaded or the gasoline ETF. It tracks gasoline prices. Nice clean uptrend line, and I had an alert trigger today, so that's a sell signal right there. You can see lots of reactions. When I say nice and clean, I mean numerous reactions on the way, no violations of the trend line. The more reactions you have like that, the more valid it is. So there's 1, 2, 3, 4, 5 distinct reactions, plus a breakdown today after a failure, a little false breakout whipsaw signal above the 33.90, about 34 resistance. I'm gonna scroll back and show you why. That that level right there, about 34, almost 34, capped all the advances back here. You were in this trading range. Here you were above it, you put in a divergent high and you had that correction. But most recently, I always put a higher weighting on the more recent reactions. And so that's it. So like XLE, we have a rally into and a failure at resistance, and now followed up by a sell signal with a break of the trend line there. The day is young. So, if you're bullish on gasoline or long, what you want to see is a snapback or recovery, a stick save by the end of the day or in the next couple days, a snapback above here, and then a solid break above the resistance. That would be hard to argue as being anything but bullish if that happens. But as of now, that's not what has happened. What has happened is a breakdown after a failure at resistance, and with pretty heavy overbought conditions down here. You can see the RSI in extreme overbought conditions right here. That 70 level is typically considered overbought. We've been pushing the 80 level plus recently. Typically when you get overbought like that, a strong rally will stall out, and you're going to have a correct. Prices will correct in one of two ways. We say prices can correct in time, and in this case it was a correction in time. We didn't go much lower, but we stopped going up, and it took several months of going sideways to work off the overbought conditions. And the other way to correct is in price. So this time around, I think the odds favor correction in price. And what would be a logical target for UGA? I think the bottom of this that previous trading range right there, which comes in around 2027. So there's your target. If you care to short gasoline, or if we got let's say a big boat to fill up, wait a couple weeks, couple months, and we should see some reprieve here on gas prices, would be my guess. Okay, next up would be gold. On yesterday's update, I mentioned we had some minor resistance here. Gold has been testing, and it still has been. That would have been, I guess, right there. And you can see we're pushing up that level. So as I like to say, resistance is resistance unless taken out. So if you're waiting to make a move on gold, add to it or buy it or do whatever, you want to wait until the resistance is taken out. There's no reason to go long just below resistance when, although your entry price is a little less favorable, the odds are much better that the trade's going to pan out if you wait for a breakout. So that's what I'm waiting for, and that level is about 1738 or so right there. And again, this is a 60-minute chart of GC gold futures. There was our bullish falling wedge pattern, complete with negative divergence. And again, a case was made for a hard buy here gold when GLD, the ETF, fell to resistance on the daily, more significant daily chart. So still liking gold. At this point in time, and possibly, again, as said back here, is a re-entry back into a long-term trade, a trade you can tuck away for months or more. And of course, that goes just as well for the mining stocks. Let me find that for you. Here we go. GDX, gold stalling out at resistance, but GDX has taken out the downtrend line right there after putting in a divergent low at support, holding that nice support level. Positive divergence down on the indicators. And so if gold breaks out, my expectation will be we run up here to any or all of these near-term targets on GDX. All right, let's wrap it up here. Keep the video short. I'll get it out to you guys, and if I see anything else, I'll follow up with another post, or anything that I missed in the securities I covered, I'll put some follow-up charts or comments in the comment section below this post. This has been Randy Finney with Right Side of the Chart. Have a great day.